Hi everyone, my name is Harsh Srivastav, and in today's video, I'm going to discuss about 5 scenarios where investing through the SIP route might actually turn out to be a disaster for your financial health. If you're new here, then do subscribe to this channel because I keep coming up with these kind of interesting personal finance videos. So without any further ado, let's get started. The first scenario is when there is a major correction in the stock market. Now, SIPs involve investing a fixed amount at regular intervals. Definitely, investing this way would bring discipline in an investor, but at the same time, since the same amount is being invested at each installment date, the investors are not able to take the advantage of the sudden fall in the markets. For example, in 2020, because of the advent of COVID-19 pandemic, the Nifty Bank Index had fallen by roughly 47% in April of 2020. Now, this was a golden opportunity to accumulate a lot of units of the Nifty Bank Index fund. The reason for this was that the chances of you doubling your money had increased manyfold. If you see the graph of the Nifty Bank Index, then you can clearly witness that investors were able to more than double their investments in less than a year. But the harsh reality is that most investors immediately start fearing further losses because they see the size of their portfolio has shrunk a lot. These kind of temporary distresses makes the investors sell their units in a fund, let alone continuing their SIPs or making lump sum investments to take advantage of the existing market conditions. The second scenario is when you choose a wrong mutual fund for a SIP. Many people just overhear the popularity of the term SIP and they think that it is such a great way to build wealth. But what they don't give attention to is choosing the right mutual fund. The effect of this is that they lose their money's worth while also losing a substantial amount of time. Let me give you an example to explain it further. Let's say you were investing 10,000 monthly for the last 15 years in PGIM India Emerging Markets Equity Fund. Your total investment in these 15 years would have been 18 lakh rupees. But do you know how much returns would you have made? Well, without any suspense, you would have made just 97,000 rupees in the last 15 years, which is an annualized return of a meager 0.69%. On the contrary, had you invested the same amount in an index fund, such as the Nifty 50 index, then you would have made around 12% annualized returns, which would equate to 32 lakh rupees, thereby taking your total corpus to 50 lakh rupees. So it is very important that you do an in-depth research of a fund before investing your hard-earned money in it. The third scenario is ignoring the inflation when investing to fund a goal. A goal such as funding a child's higher education can become really far-fetched if you ignore the inflation rate when setting the target amount to save. For example, let's say it cost 20 lakhs today to fund a postgraduate degree. If you would invest just 5,000 rupees monthly for a period of 15 years and assuming the rate of return is 10%, then you would be easily able to reach your target amount of 20 lakh rupees. But wait a second, wouldn't the cost of education also increase in these 15 years as well? Well, of course it would increase, and so you will have to take into account the inflation rate as well. If we take 6% rate of inflation, then your target amount would actually be 33 lakhs instead of 20 lakhs. To achieve the same, you will have to invest 8,000 monthly instead of 5,000, and then your goal will be met. So whenever you invest for a distant goal, you should always take into account the inflation rate. The fourth scenario is untimely exit from SIPs. Making money from investing in SIPs is a long-term game. Sometimes the markets move in a parallel direction for 2 to 3 years, and so you wouldn't see much of a gain in your investments in that time frame. This situation makes a lot of investors anxious and they start contemplating about FD being a better choice because of stable returns. However, if you were to see the returns of most equity-backed schemes, then you will observe that these funds perform really well in the longer time horizon because then your investments get ample time to compound. For example, if you see the Axis Blue Chip Fund, then the 2-year CAGR returns for the fund stands at just 1.96%. And so an investor might see this as a huge red flag and exit from the scheme immediately. But if you were to see the 10-year CAGR returns, then you can clearly see that Axis Blue Chip Fund has given a return of 13.91%, which is honestly quite impressive. So if you are in it for the short term, then you are better off not investing through SIPs. Additionally, one more mistake that people tend to do is not exiting from their SIP when they are near to their goal. The markets are always volatile, and so to avoid facing a market crash when your goals are in the near term, you should always exit from your risky investments and shift your accumulated money in liquid funds, low risk debt funds or FDs. The fifth and the last scenario is choosing the dividend option over the growth option. The whole point of doing a SIP is to get the benefit of compounding. In dividend option, profits made by the mutual fund scheme are paid out to the investors at certain intervals, which is mostly annually. These dividends get used up by the investors for random expenses. On the other hand, in the growth option, the profits made by the mutual fund scheme are reinvested by the fund manager, and so you get the benefit of compounding as years pass by. Therefore, until and unless you are in a dire need of a regular income from the mutual funds, you should always choose the growth option when opting for a SIP. Hope this video was helpful and you learned something new today. Thank you so much for watching. Like the video, hit that subscribe button and stay tuned for my next video.